There are really two concepts that finally inspired me to get in the market. These two concepts taught me that you don't have to be super rich to start investing. You start investing to build wealth and ultimately become rich. I was always really intimidated to enter the stock market and start investing. But the first concept I learned about was index funds. And once I learned about those, I knew that I could do this. The second concept I learned about was dollar cost averaging. While I've mentioned it in my other videos as the core of my investing strategy, I haven't really gotten into a lot of the benefits of it to explain what it is and why it should be important to you. I'm going to share some of the exact things that I read and saw that convinced me that I could be an investor and I could be successful at this. If you're interested in investing and budgeting concepts and ideas that still allow you to live a fabulous life, then go ahead and hit subscribe right now so you can follow along with Champagne Sense. I know I would be really happy to have you as a subscriber, and also my production crew, Nikita, because she's working very hard behind the scenes to bring you exciting content. Dollar cost averaging answers the question, when do I invest? How do I know it's the right time to put my money into the stock market? The answer is always, at consistent and regular intervals. With dollar cost averaging, you don't have to worry about researching and knowing the stock market ins and outs because you don't have to worry about what is the perfect timing. As I've talked about before, that's really where you get into trading, not investing, because you are spending your time and your efforts researching stock prices and understanding how they're going to fluctuate. Stock price is heavily influenced by opinions and emotions. It's essentially the market determining what the company is worth. Stock price is not a reflection on the intrinsic value of the company. With dollar cost averaging, you are determining the amount and the frequency of your investing. For example, you may want to invest every 2 weeks on your paydays. You may want to put money aside every paycheck and then invest that money every month or every quarter or twice a year. Whatever the frequency and the amount is for you, this is dollar cost averaging. You've already decided the frequency and the amount of your investing. So when that day comes, the market may be up, maybe down. Either way, you're going to invest the same amount of money. Hi, Nikita. Do you want to talk about dollar cost averaging? Huh? She agrees that dollar cost averaging is the way to go. Since you've already decided the amount and the frequency of your investing through your dollar cost averaging strategy, the market will be at different prices when that investing day comes. This means that if the stocks or the funds that you've chosen to invest in are extra high on this day, your money will buy you less. Alternatively, if the market is down and the shares or funds that you've decided to buy are at a lower price, your money will buy you more of those securities. Ultimately though, it all averages out. Let's take a look at an example right now to get a better idea of how this really works. Let's say investor number 1 has $10,000 to invest, and they are going to invest it in one lump sum. Investor number 2 is going to invest $1,000 a month over the course of 10 months. You get what I'm saying here? There's 2 investors, both have the same amount of money, $10,000 to invest. Okay, good. Let's go to a visual then. So investor number 1 is going to buy a stock, just make it up, but let's just say it's $50. So they invest their $10,000 at $50 a share. Now we know that stock price is going to fluctuate over the course of 10 months, but at the end of those 10 months, that investor is in for $50 a share, and let's just say that although it fluctuates, at the end of this period, it is back to $50 a share. Their return on an investment is 0% because they bought it at 50 and now it's worth 50. Now let's look at investor number 2, who's investing $1,000 a month over this period of 10 months. In month 1, they invest at $50 a share, just like investor number 1. And we're still gonna end at the same point in month 10 of the share being worth $50. But let's just say here's how it fluctuates over the course of those 10 months. Because they're buying $1,000 every month, sometimes they're buying over $50, sometimes they're buying under $50. In this example, their average purchase price of this share is $48.20. So although they started and ended in the same place as investor number one, you can see there's a better return on their investment because their average price is under 50 bucks. This is a great reason why dollar cost averaging is amazing. That average price piece really spoke to me. And it helped make me feel a lot better that sometimes I'm going to buy my stocks a little bit high, but that's okay because sometimes I'm gonna buy them a little bit low. It'll all average out over time. If my lump sum investing versus dollar cost averaging example didn't quite land with you yet, let me give you another one. I've talked about The Intelligent Investor before, written by Benjamin Graham. It's a pretty beefy book and it was written a long time ago, actually before index funds even existed. But a lot of the concepts still hold true and you can get versions that have updated material. There's one example in here though that really inspired me and drove this point home, so I want to read that to you. So I'm just going to read you a little example here because I'm assuming you have not read the book yet. So I will just skip to page 131 and share this. So a little history lesson. First of all, the Great Depression was in the late 20s, and what they call Black Tuesday was October 29th, 1929, which was the huge dip. So with that little history lesson in mind, remember, October 1929, it was some bad times. If you had invested $12,000 in the S&P 500 stock index at the beginning of September 1929, 10 years later, you would have had only $7,223 left. That makes sense, right? So if you invested right before the major crash in one lump sum, you would have lost money and your $10,000 would then be $7,000. But if you had started with $100 and simply invested another $100 every single month, then by August 1939, your money would have grown to $15,571. So you see, just doing smaller but regular intervals of investing, it all averaged out and you would have taken your money and increased it to $15,000. I'm going to confess to you that I am actually super duper lazy and I don't want to spend all my free time after I work my 9 to 5 analyzing stock prices, company financial statements, calculating intrinsic value, anticipating the market swings in price. So dollar cost averaging makes my lazy girl heart sing because it is on autopilot. I have my index funds and stocks picked out. I have my investing schedule, and so I know how much I'm gonna put in. I know that sometimes I'll buy more and sometimes I'll buy less, depending on what the market is doing, but it's going to average out over time. While I'd love to get rich quick, it is not a realistic goal, so I am fully prepared to be a long-term investor and capture the growth of the entire market over time. Another book that I've talked about before that really inspired me to start investing is good old Tony Robbins. While I'm not his biggest fan, this book is pretty incredible and it really puts investing concepts into layman's terms. There was one section in particular on page 44 and 45 that really set off a light bulb for me. It looks like this. Look at all the highlighting, look at all the stickers. This book is well loved. I'm gonna put this graph on the screen so you can see what I see. So this looks at hypothetical investors that have about $2,000 in cash to invest once a year for 20 years. The time span is from 1993 to 2012. So I know it's a little bit outdated, still captures some significant market movement, but I'm just sharing what I read and what inspired me. So that's the time frame of this chart. The perfect investor is really what we would all like to be. This assumes that you invest your money at the optimal time each time you put your money in. So the optimal time is when the market is at its lowest, when you are buying stocks at their cheapest. Immediately is lump sum investing, and it really takes advantage of the overall market movement over this period of time from 1993 to 2012. Next, you see dollar cost averaging showing results of over $79,000. Not a significant difference if you were to invest immediately in this example, but take a look at dollar cost averaging compared to if you were to invest at the worst possible time or when the stock market was at its peak. Really, what should stand out to you though is the comparison of any of these compared to not investing at all and just keeping your money in cash. When I saw this big difference, I immediately went to Vanguard and opened up an investment account. The biggest mistake that you can make in investing is not being in the market at all. And that graph really demonstrated that. If you keep your money in a savings account, you're actually losing money because of inflation. This means that your $1,000 in your savings account is buying you less and less as the years progress because your purchasing power is reduced. Everything is costing more year after year and your money buys you less. This drove home the point that dollar cost averaging into low cost index funds really is a great way to get started investing while maybe you're learning about some of the other fancy stuff you want to do, if you want to do it at all. Granted, I'm not a financial advisor, so do what you want, but I think this strategy is definitely something to look into. And what I've seen from financial advisors, I don't think many would dispute this, unless they were getting paid to put me in a different investment. I've done some videos on how I do dollar cost averaging, and I recommend checking it out because you can see what I invest my money in and how I do it. In a nutshell though, I have anywhere between $100 and $200 direct deposited from my paycheck into a separate account. Every 3 months, I then take that money and invest it with my Vanguard Index funds. It's also like a built-in emergency fund because I can always pull from that over the quarter if something pops up. And I can also change how much I'm direct depositing from my paycheck. I just bought a new Jeep, for example, and I had to redirect some of this dollar cost averaging money into my Jeep purchase. The point is, I know that time in market is the most valuable thing I can do, so I never stop putting money aside for my investments. And dollar cost averaging doesn't mean I can't take advantage when the stock market dips and my favorite dividend paying companies see a drop in price. I still have money set aside for that type of investing, but I don't want to stray too far from the core of my investing strategy. Building your wealth doesn't mean you have to sacrifice living well. Dollar cost averaging is autopilot so that you can make money and still live a fabulous life. You don't have to be a slave to charts and graphs to analyze the prices of companies, knowing when to invest your money. Please give this video a like if you participate in dollar cost averaging, and comment down below with any feedback you have for people looking to start investing with dollar cost averaging. And I know that you are already subscribed because you know how much it would mean to me.